Guys, let's get started. So, Iron Condors, session 2, we're going to be looking at some trade examples. I'm going to walk you through some trades and talk about what happened, how we adjusted, how we managed them, and a few different things as well, and how we're handling this low volatility environment as well. Okay, so just a quick disclaimer that any information contained in this presentation is for educational purposes only, and nothing is to be considered investment advice or a trade recommendation. No representation is being made that any portfolio will or is likely to achieve profits or losses similar to those shown. Make sure you check out the disclosure document, characteristics and risks of standardized options, available from optionstradingiq.com/risks. All right, so let's get straight into it tonight. Got a lot to get through. So first trade we're going to look at was a 49-day unbalanced iron condor that was started on January 26th of 2017. So you can see here we've done an unbalanced condor with the skew that's been evident in the market at the moment. In order to get close to delta neutral, we had to trade less of the call options or call spreads than we did the put spreads. So we're doing 10 of the put spreads, 7 of the call spreads. You can see there our delta is -4. If we multiply that by the index price, we get our delta dollar figure, which is -5,000, which is a pretty good starting point. So that's about where I usually like to be, somewhere around there. Delta as a proportion of theta, our ratio is under 10%, so that's good. Okay, so pretty standard setup that we've been looking at for this year. A couple of days later, Russell has dropped a little bit, dropped from 1375 to 1352, drop of 1.72%. VIX has risen from 1063 to 1188, a rise of 11%. However, volatility is still pretty low. So far, the trade's down about $100 compared to -$20 for the 84-day condor. So at this point, we were trading a 59-day condor and an 84-day condor. And as I said in session 1, the longer-term trades tend to move a little bit slower. And you can see that here, the 59-day trade's down $100. The other one's only down $20. So delta has swung from -4 to +17. Vega's also come down a bit. Delta dollars is 23,693, so still within acceptable boundaries. In comparison, the 84-day condor has delta dollars of only 10,000. So you can see that longer-term trade was moving a little bit slower. Okay. Hopefully that makes sense. So here we are, position at the moment, no reason to adjust. Okay, our delta dollars is still okay. We're risking about 18,000 on this trade. Delta dollars has only hit 23,000. I wouldn't look to adjust until it hits double the capital at risk, so about 36,000. Okay. So we've come back sort of into the middle of the structure, which is kind of good. But because we're trading more of the put spreads, even though we're more or less in the middle, we've got positive delta. Okay, the purple line you see there is 2 weeks from today. So we're going to do well if the trade stays pretty neutral. Fast forward another week, and we've been in the trade for a week and a half, and the Russell is almost back exactly where it started. So perfect conditions for an iron condor. And at this point, the trade's up $345. Or 1.93% of capital at risk. In comparison, the 84-day condor is up $270. So again, that longer-term condor, it's moving slower when it moves against you, but the profits are also accruing a little bit slower as well. Greeks look fine. Our delta dollars is 12,400, and delta theta ratio is 13.6%. So the 9 delta divided by 66 theta, 13.6%, so that's quite reasonable as well. We'll go through some of these rules in the next session, but just quickly, as long as that ratio stays under about 30% on a trade like this, I'm pretty happy. The delta of the short put is at -8.75 and the short call is 6.86, so really low risk at this stage. It's well within acceptable levels. Okay, so just an update here, nothing needed in terms of trade management. the position's just working slowly in our favor at this stage. So here we are at this point. We've made a little bit of money. That income line has come down a little bit. Interestingly enough, we've got a little bit of positive delta, even though we're closer to the short calls, again, because we're trading more of the puts. So we've got 6% margin on the upside and 8.5% margin on the downside. Okay, fast forward another week. Trade's doing well and is currently up 775, but is starting to pick up a little bit of negative delta. From a portfolio perspective, it makes sense to adjust this trade and bring delta back close to zero. So what that means is, at the time, my risk parameters on this particular trade were all okay, but if I had some other positions in my portfolio that also had negative delta, I wouldn't want 2, 3, or 4 positions that all have negative delta. So what I wanted to do with this one was adjust it, bring it back more to delta neutral. So it's important to look at these trades individually, but then also look at things on a portfolio basis as well, which we'll talk about in a bit more detail later today. Okay, so the trade's doing pretty well. We're up 775. Russell's only gone up about 20 points over the course of a couple of weeks, but we're starting to pick up a bit of negative delta. The puts have really decayed. The put spreads aren't really worth much anymore, only worth 50 cents. The delta on that short put has dropped to 5.5, but the delta on the short call is 13. So we've got a bit more risk on the upside. So how do we adjust it? We're rolling up the puts to bring in some extra income and also get delta back to a more neutral level. The added bonus with this one is that the adjustment brings in another $990 in income. So it's a fairly aggressive adjustment. Okay, but it's two benefits to this adjustment. Brings us back closer to delta neutral and also brings more income potential into the trade. So after the adjustment, the trade is more or less delta neutral, with delta dollars changing from negative 31,000 to plus 3,600. Theta has increased as well. We're getting more time decay because we've brought those spreads in. We've brought in more income, and Vega's also increased a little bit, but that's okay. So before adjustment, you can see here 31,000 negative delta dollars. Our delta is negative 23 divided by 76, so that ratio is getting up a little bit higher again. And then after the adjustment, well, this is the graph before the adjustment, we've only got 4 and a bit% margin for error on the upside. We've got nearly 10% on the downside. So we're a little bit skewed. We're just going to roll these puts up a little bit and make the Condor a bit more central. You can see here that income line has come down. We initially had a couple of thousand, over 2,000 in income potential. It's come down a little bit. And you'll see on the next graph, by rolling the puts up and bringing more income potential into the trade, that line goes back up again. We've got much more income potential again. So after the adjustment, we're now short the put spreads at 1320, 1300. Gives us a bit more of a central looking graph, so 5.5% on the downside, 4.5% on the upside, back to pretty much perfectly delta neutral. Delta theta ratio is really good, it's really low. Delta dollars is good, it's really low. We're short the 14.5 delta puts and short the 13 delta calls, so pretty even there, and generally pretty nice looking trade at this point. Okay, so Feb 22nd, trades up 1500, which has exceeded the profit target. All the risk parameters are okay, so it's also fine to hold it for a few more days. Okay, so even though the profit target was exceeded, because delta was basically pretty close to neutral, the trade was pretty central. 1320 puts are at delta 10, 1460 calls are at delta 10. I decided to keep it open for a bit longer and try to pick up a bit more time decay. From a risk perspective, none of our warning signs had been hit at all. We were looking really good at this point. So here we've got still 4% on the upside, 6% on the downside. Still got a lot of income potential in the trade. A couple of days later, we've picked up another couple of $100. We're up 1,800 now. We're getting within a sort of 3 weeks to expiry now. So delta's going to start to change a little bit more. Gamma is picking up a little bit. Our delta dollars has swung from negative 9,000 to positive 23,000. So Russell's dropped a little bit. We've now got positive delta. We want the market to go back up. You look at those call spreads, they've really decayed. Not much value left in the call spreads at all. The short calls are at delta 4, so very low value there, very low risk. A lot of the risk now is on the put side. So our delta dollars swung a fair bit, even though Russell only dropped by 10 points. The call spreads are now worth very little, and the short call is only delta 4. Short puts delta negative 10, and the position is very central, well within our risk parameters. Again, that delta dollars number hadn't hit our adjustment parameter. Look at that theta. As we're getting closer to expiry, that time decay is really picking up. So even though we've got a little bit more delta than we did earlier in the trade, it's still only around 10%, just over. Okay. So we're totally fine to leave the trade as is. We're perfectly central on the graph. You can see it's come down over the course of a couple of days from 2,000 in income left in the trade to only 1,700 now. So we've made about $300 in a couple of days. And then with this one, we held on to it for another week and closed it out for a gain of 2,400. It was a pretty nice trade. First green arrow there is the entry point. Second green arrow was when we adjusted. We rolled up the puts and we exited on the red arrow. So pretty nice trade. The Russell, generally moves pretty sideways over the course of the trade. So that's exactly what you want. Pretty much a perfect scenario. Very, very easy, no stress trade. Okay, so let's look at a different example going forward to March now. We've got a 78-day Condor. We're going unbalanced again. And we're bringing in 3,600, capital at risk of 16,000. So going a little bit more aggressive than I normally do. Delta of 13 on the puts, delta of 10 on the short calls. So we're bringing in a little bit extra income here because we're being a little bit more aggressive on the put side. And part of the reason to do that is because of the skew again. So even though we're short the 13 deltas on the put side and short the 10 deltas, so there's a bit of a difference, because of the skew, we're still more or less delta neutral. So again, pretty nice starting point. The negative 5,000 for this position size is pretty good. Delta to theta ratio, 10%, that's good. So again, another fairly standard starting point. You can see you can kind of tweak these just a little bit depending on number of contracts or what delta you're doing. But as long as you're more or less starting with that delta neutral position, or slightly negative delta is usually okay, then you're going to be pretty good. So Russell's at 1371. There's our income potential. And what date do we start? March 29. So we go almost a month before we had to do anything. Okay, so we've gone to April 25th. This trade was looking really good 2 days ago when Russell was at 1379, so it had barely moved over the course of a month, and the trade was up about 2,000. Then we had a really quick rally over a couple of days, rallied up to 1411, and as soon as give back some of the profits, although it's still up 750. So we've given back 1250 in just a couple of days. Now maybe we should have closed it out a few days ago when we had the gain of 2,000. Okay. But we didn't, we held on to it. We took a bit of a hit in terms of our profit as the market rallied. And because we're in such a low vol environment at this time, it didn't really rally that far. It's only rallied a couple of percentage points and we've lost 1250. So let's look at the trade. The delta of the short call is only 13.4, so we're okay in that regard. However, delta dollars is a little high at negative 44,000. Given that the trade is only risking 18,000. So we're over double. Our delta dollars number is over double our capital at risk. So for me, that's a little bit of a warning sign. So the first step is the defensive move of rolling the calls out. We're going to roll them from 1490, 1510. We're going to roll them out 20 points to 1510, 1530. It's a defensive move, gives us a little bit more margin for error on the upside, but it costs us to make that move. It costs us $720. So to help pay for that adjustment, what we also do is roll the puts up from 1240, 1220 to 1300, 1280. So we're actually rolling the calls out 20, and we're rolling the puts up 60. So that's an aggressive adjustment on the put side. Rolling them up brings in $700 in income. So the net cost of the adjustment is only $20, and it gets us back to delta neutral. Okay, so we're taking some defensive action on the calls. It's costing us money. We're taking some aggressive action on the puts, and that helps to pay for the adjustment. Yeah, exactly. We're basically recentering the whole position. Same as basically taking it off and recentering it. So we could have just adjusted the calls and left the puts as they were, but we would have still had a lot of negative delta. So I preferred to take the whole position off, recenter it, and get back to delta neutral. So you can see here delta of 13 on the short calls. If we roll it out 20 points to 1510, we're going to be delta 8.5, so much lower risk. The delta on the short puts was only 6. And the spread only had 60 cents in value in it, so not giving us much at all, so we roll those up. That delta theta ratio, 31 to 56, also a little bit high. So here we are before the adjustments, got about 2,400 in income potential left in the trade. After the adjustment, pretty much the same amount, 2,400. So it hasn't really cost us anything to do this. Got us really central again, 7% margin on the upside, 8% on the downside. Just about perfectly delta neutral. Delta of 1, so obviously our delta theta ratio is really good again. Delta dollars, basically non-existent, and we've got a really nice looking trade. We're delta 12 on the short puts, delta 8.5 on the short calls. So again, the volatility is higher on the puts. And you can see it doesn't drop away quite as much when we're buying the 20 points out, 9.5, whereas this drops away a bit more. Okay, so another week or two go by. Trade doing nicely, up 1770, including plus 400 in the last week. All our risk parameters are okay. Delta of the short puts is 12.7, and delta dollars is okay at 21,000. However, with volatility very, very low and Russell looking a little shaky, I would take profits here. So we've exceeded our profit target. Our risk parameters were okay, but it was prudent to take the profits here. So this was the trade. First green arrow is the entry. Trade was looking really good over the course of the first 2 weeks or so, basically flat, and then all of a sudden we had this big 3-day rally, and that was where we adjusted. Russell pulled back a little bit, and we got out of the trade. Now we could have just left the position as it was. We would have ended up being okay, but if Russell had have really rallied hard from here, it would have only taken a day or two and the position would have been in real trouble. All of a sudden we've gone from a $2,000 winner to potentially a $500 or $1,000 in the red on this trade if Russell had kept rallying. If you look at the chart here as well, this was kind of the all-time high at around 1420, and we were just breaking out above that level. So you could say maybe I didn't need to adjust it, but I argue that I took the safe option. And if I didn't do anything, and this is where I see a lot of people getting into trouble, is they leave it and sit there and hope that the Russell's not going to rally up and test their strikes. If the Russell had rallied 20, 30 points over the next couple of days, that $2,000 gain would have been looking at a $500 to $1,000 loser. So you've got to adjust early, you've got to stick to those rules. All right, a couple of questions. Do you always try to finance the debit roll with the same credit from the other side to break even? Not always. I don't mind paying a little bit to make an adjustment. It depends, if I want to be really defensive or if I don't mind being a little bit aggressive on the untested side. Sometimes I might just roll the calls out and I'll pay for that and not touch the puts if I think the market might reverse back down. So yeah, it's always nice when the adjustment doesn't cost you much, but sometimes I'm willing to pay a little bit for an adjustment as well. And another really good question, when adjusting an iron condor, do we need to consider how many days remain in the trade? Yeah, definitely. So mentioned it briefly in session one, but I'll talk a little bit about that now as well. The closer you get to expiry, the harder these things get to adjust. So I generally don't take these trades into the last week unless I'm like right in the middle of the condor. And even about 2 weeks out, I start to unwind the position, because what happens if you get into that 2 to 3 weeks till expiry and the trade starts to get under pressure, it gets a little bit harder to adjust. And if you adjust and the market keeps trending against you, all of a sudden you're in a lot of trouble. And you've got to adjust again, and you're really fighting the trade, and then you're fighting it for those last couple of weeks. And your P&L can be moving around a lot as well as you get closer to expiry. So I prefer those longer term trades, particularly in this low vol environment. So 60, 80 days out, I'll look to adjust it once if I have to. If I'm looking to adjust a second time or a third time, then the market's trying to tell me something that it's not working, and I'll get out. But in terms of time to expiry, yeah, definitely. If I'm getting under pressure with a position and there's only 2 weeks left, I haven't got a lot of room to move if it continues trending against me. So I generally just get out. So yeah, really good question. All right, next trade. So next month, April 19th, doing another 78-day trade, unbalanced this time. Now this one is a really good one. So, pay attention to this one. It's a good learning one. So something I've been doing a lot this year, and everyone's worried about this low volatility environment. What are we going to do if volatility spikes back up? So what I did with this trade was I added some protection in the form of a long strangle a couple of months out. So Russell's at 1360 odd, starting the trade with a delta neutral Condor. It's unbalanced. We had to do less call spreads to get it fairly neutral. So you can see there the June line, you can see delta is 0. Delta dollars is negative 348. So that's our Condor. And then the delta of 1 or 2045 delta dollars is the total position, which includes the September strangle that we're buying. Okay. So you start with your standard Condor, and then what I did is I went out a couple of months and I just bought the same options that I'm selling, almost like you would do for a calendar spread. So I'm short the 1240s in June. I go out to September and buy one of the 1240s. And that's a pretty decent ratio that I usually use, is sort of 1 or 2 strangles per 10 condors that I'm doing. Okay, so it didn't have any effect on delta really. I'm buying the 21s and the 23s, so pretty much neutral. But look at Vega. So you're worried about a volatility spike, and yes, you can be with iron condors. It does make sense to worry about that because your Vega is negative 356. You're short Vega. If volatility goes up, you lose. So what we're doing is we're adding some positive Vega. So look at that, 516 on the strangle that we're buying, which more than offsets the Condor. So we've actually now got positive Vega on the trade. Now what's the trade-off? We've got lower theta, because this is costing us a bit of money to hold this each day. And this theta column, as a general rule of thumb, taking the Condor for example, it's got theta of 47. It means roughly if everything else stays the same, if Russell doesn't move, volatility doesn't change, none of the other Greek or option pricing inputs change, you'll make $47 a day in time decay. All right. Now that's offset with this example because we've got some protection. It's costing us $31 a day. So our theta is only actually $16 a day for this trade. So that is the trade-off. You're buying some protection, a little bit of a hedge for your vega, so you've got less time decay. Okay, so that gives us a graph that looks like this. And I'm going to show you another example after this one as well, so we can lock in the concept. But normally with this sort of trade, you'd be bringing in, you know, $3,000 or so in income. Okay, but because we're buying that straddle, we've got this big dip. Now we're still making around 5% on our trade if Russell stays flat. We're still going to make $600–700 on our 16,000 at capital at risk. So we've got a little bit of a lower income potential, but that's okay. We're still going to make a nice 5% return. You know, we could potentially end up in this area somewhere on the downside or the upside. This purple line, the T+0 line, or maybe this was T+7, it's a little bit flatter, and I'll show you another example in a second than it would normally be. Okay. The tricky thing with these ones is adjusting, because you've now got 6 different legs in the position. So it can get a little tricky when you're adjusting, but I'll walk you through what happened with this one. So we started the trade April 19th. A week later, we needed to adjust. Russell had gone up to 14.11. Okay, looking at the position, currently down $160, so nothing too bad. Our long strangle has given us a little bit of protection. The call has increased by 11.45, but the put has dropped by 9.65 for a net gain on our hedge of 160. So it's doing its job so far. So basically, if we didn't have that hedge, the trade would be down 320. Okay, as it is. The hedge made 160, so that offsets the loss, gives us a net position of down 160. As I said, part of the issue with having a trade with a hedge is that it can get complicated when it comes time to adjust. So this is a multi-part adjustment. Okay, we're moving the calls, we're moving the puts, and we're also moving the put hedge that we have as well. Okay, the delta of the short call is 20.5. Okay, so around that level where we want to look to adjust, and we're getting close to being 3% away. If Russell continues rallying hard, the call spreads could start to see some serious losses. As such, I'm moving the call spreads up, a defensive move, again moving them up 20 points. This adjustment costs $700, similar to the last example. Since we've rallied 65 points, the put spread is now 12% away and not doing as much good. As such, I'm rolling them up, another attacking move to bring in extra income and help pay for the call spread adjustment. So again, we've rolled them up 50 points this time from 1240 to 1290, brings in $600. So together, we've paid $100 for the adjustment. Then after we've done that, having the hedge at 1240 isn't giving us much protection, not doing us much good. So I'm also moving that up to 1290, which also keeps it at the same strike as the short puts in the Condor. So a little bit of a complicated adjustment, but hopefully you can follow along. Might help when we see it visually with the graph. So here the market's rallied up. Delta dollars is okay, but the delta of this short call is a problem. It's at delta 20. So that's a concern for me. So I want to move that away, because it's at that level that if the market keeps rallying, losses are going to pick up steam pretty quickly. And you can see that on the purple line. You know, from -5 to 0, that purple line's pretty flat. But if we rally another 2.5–3% from here, all of a sudden we're down $1,000. Okay, so we've got to do something. Got to do something now before it's too late. So we roll the calls out, we take some defensive action, we roll the puts up. So again, basically repositioning the whole Condor, and then we also roll the hedge up as well. So that's what the new position looks like. Gets us back to similar to how we started. back to delta neutral. And that purple line, we're more in that central bit where it doesn't drop away too much. We've got, 2 to 3% up or down that we can withstand without suffering too much of a loss. Then once it gets past that point, the losses start to accelerate. All right, just pause for another question. So to what extent do you use technical analysis versus the Greeks to manage the position? So I use a little bit of both, but I'd say primarily the Greeks. So again, just going by that trading plan, those key rules, the delta dollars, the delta of the short strikes, those are the two main ones. Then the 3% rule, and also the spread doubling or going up 200%. But yes, I'm also looking at technical analysis. If the market's really, really overbought, it might influence how I adjust. But in terms of management, I definitely give more weight to the Greeks than I do technical analysis. All right, so that was our position after the adjustment. Russell's at 14.11. Fast forward a couple of days. June 15th, the iron condor has expired worthless, and the September strangle is still worth $3,000, giving us a total profit on the trade of $16.90. So you'll see on the next chart, the Russell ended up being pretty flat over the course of the trade, so the hedge didn't do us much good. If we didn't have the hedge, we would have actually made $3,500 on the Condor. I think that's meant to be $2,500, sorry. $2,500 gain on the Condor and a $13.20 loss on the hedge. Okay, so we don't mind that we lost a little bit of money on the hedge because it was giving us that protection. So this was the trade. That's our entry, the first one. Then Russell rallies pretty hard within a couple of days. Worst case scenario for your Condor. Same on the downside, but an extended move over the course of the first 3 or 4 days of the trade, that's the worst scenario. That's the worst thing that you want to see. You want to have a good week or so where the trade just drifts sideways. That's perfect. Gives a little bit of time for the time decay to kick in. So we adjusted and then ended up being completely flat over the next couple of months or couple of weeks. So maybe we didn't need to adjust, we would have been okay, but again, that delta had hit 20 and it hit it fairly early because we had an aggressive move up in a couple of days. And if the Russell had kept rallying, again, this was, I think I had 2 overlapping trades on at the time. This was that same period when we're breaking out to new highs. If the Russell had have gone up another 40, 50 points, those call spreads would have been in real trouble. If we go back to that adjustment screen, where were we? Here. If the Russell had have gone up another 3%, we're right up here near the short calls. We're giving up a lot of profit. How about, Angel's saying, how about the May 22 drop in the Russell? So this one here, I don't think it impacted the position that much because we probably had a bit of negative delta coming in through here, and we started the position here, and also the hedge really helped us here on this day. I think the hedge gained about $300 on this day because it was a pretty violent move down. What I could do is maybe if we get time, I'll run that through OptionView, which is like a back testing software. All right, so really interesting trade, that one. And what I'm going to do now is just switch up and go here and show you how I'd set this sort of thing up today. Okay, so we've got our standard kind of iron condor. Again, it's not a trade recommendation, but just an example. Standard iron condor that we might set up today, unbalanced. So we're selling the 12 deltas, we're selling the roughly 10 deltas, more or less delta neutral, delta theta's 10%. Okay, we got 5 and a bit % on the upside, 7 and a bit on the downside. It's a pretty standard sort of setup. Now, if we wanted to add some protection, we've got our just over 2,000 in income potential on capital at risk of just under 18,000, so we're above 10%, which is good. Now we could go out to December, and if I buy a put using the same strike, 1340, and I buy a call at 1520. Delta's pretty much the same. Obviously our delta theta ratio is a lot different because our theta has dropped a lot. Hedge is costing us $29 a day, whereas we're only bringing in 41. Now I could go out to January or even March if I wanted to. It's going to cost me a bit more, but we can look at that as well. The main thing I wanted to show you here is the difference in this purple line. So let's say we put this trade on and North Korea drops a missile or something and the market's down 5-6% tomorrow. Okay. Without the hedge, 6% down, we're down 3.5 grand. With the hedge, we're still going to be down, obviously. It's still a bad scenario. Down 6%, we're only down 1750. So we've got that little bit of protection. We've still got losses. We still want the market to stay more or less neutral, but we're protected a little bit if the market tanks or rallies. Yeah, really good question from Mike. So something that we've been looking at, Mike, recently is, we'll have, rather than just doing one hedge for this particular Condor, we'll have a long-term hedge that we'll have. So we might go out 6 months or 9 months and buy the strangle, and then we'll be trading Condors every month against that position. So it's going to cost us more money if we go further out in time. Let's say we go out 4 months to, say, March. I might want to choose slightly different strikes. I might not want to be 1340. And maybe I want to be, say, 1320, delta 22. So it's going to cost me a lot more. It's going to cost me 2.5 grand as opposed to only 1,000, but the time decay is going to be a bit less as well. And on the call side, I want to be around delta 22 as well to keep it delta neutral, so 23. So I could buy these instead. It's going to give us a much different looking graph. Actually fairly similar. Okay, down 6%. Actually not giving us as much protection, interestingly enough. Maybe because we're a little bit further out. But yes, you can do this. And now this is costing us 4,000 to make this hedge, and we've got November, December, January, February, March. We've got 5 months to make money with our Condors. That'll be much more than this hedge, hopefully. So if we can make 1,000 to 2,000 a month with those Condors for 5 months, we've more than offset the cost of the hedge. And this hedge might hold its value for a couple of months a little bit. So I might hold it for 2 months, then I might take it off and roll it out so that I'm minimizing the time decay. Sort of advanced concepts here, guys. So if you're kind of new to this stuff, don't worry too much. It's kind of pretty advanced. If you are overwhelmed, don't worry. But that's just one way that you can handle this low volatility environment and protect yourself against a big, fast move. We'll talk a lot more in one of the bonus sessions that we've got on volatility. We're going to talk a lot more about that sort of thing as well. So we will cover that again. Okay, so moving forward, another trade, May 23rd, 59-day unbalanced Condor. Again, pretty standard setup. We're having to go unbalanced because of the volatility skew. You look at the implied volatility on the puts is 20, 21. On the calls, it's only 12. That's why we're trading less calls to stay a little bit delta neutral, maybe a little bit more negative delta than I'd normally like. You see that delta theta ratio is more than like about 20%. But that was how we started this one. 6.5% margin on the upside, 9.5% on the downside. So, looking back, maybe I could have moved the puts up a little bit closer. we bring in 2,500, so nice income potential on our roughly 18,000 capital at risk. Okay, June 12th, hasn't taken much to put this trade under pressure. That's the trouble with a low vol environment. Russell has moved from 1370 to 1419 and the calls are now in need of adjustment. Okay, so if we look down at the image there, those 1470 calls, delta 20, look at delta dollars as well. Delta dollars is at negative 60,000, which is over 3 times capital at risk. This is too high. While the position may be okay for now, any further upside is going to really start to hurt and also make the position harder to adjust. Better to adjust now while we can, rather than when we have to. The delta of the short call is also over 20, or only about 3% away. The adjustment is a pretty simple one. We'll roll the calls up 20 points. And again, in order to help pay for that adjustment, we'll roll the puts up by 50 points. So we'll go and just look at the graph. So this trade started May 23rd. Let's have a look at the Russell, May 23rd. So around here. Then we went down and then boom, we shot up. So we started at around 1377, something like that, 1370, and we shot up 4% pretty quickly, pretty early in the trade. 4% is not a massive move, but in the low vol environment, it starts to impact you pretty quickly. So before adjustment, we're delta negative 60,000, that delta theta ratio, 50%, pretty high. Delta of the short calls is 20, so a couple of our rules have been hit. Definitely time to adjust. If we didn't and we left it longer and the market continued to rally, that's where people really get into trouble. You've got to, in my opinion anyway, you've got to adjust early. Otherwise you get into too much trouble, it gets too hard to adjust. I get emails all the time from people saying, you know, I've got this iron Condor, my calls are at 1470, 1490, and the Russell's at 1465. What should I do? Well, to be honest, at that point, it's almost too late. There's really not much you can do other than just sit there and hope that the Russell drops or doesn't go above 1470. You've really got to adjust early and take some defensive action. Those losses, if you don't act early, they start to steamroll a little bit, or snowball. So here you can see massively unbalanced. Really close on the call side, lots of room on the put side. So I don't mind rolling the puts up and being a little bit aggressive there, but I definitely need to take some defensive action on the call side and move those out. So after the adjustment, we're a little bit more central. It's cost us a bit of money. So income potential was 3 grand here. We're now only about 2,100. So it's cost us a bit to make this adjustment, but that's okay. We wanted to have some defensive action. I've moved these out to now 5% away, a little bit more margin for error. Delta theta ratio is a little bit better, sort of 20-25%. Delta dollars is back sort of 1-to-1 with capital at risk, so that's better as well. Okay, so question. So rolling in this case isn't really any different than taking off the whole position and then putting on a whole new position, correct? Yeah, more or less. That's basically what we're doing. We're adjusting both sides, so we're just repositioning the whole thing, and that's certainly one way you can adjust. Lots of different ways to adjust, and we'll talk about that in the adjustment session. But this is kind of the easiest one to understand. It's pretty simple. Take some defensive action on the under pressure side. You take some aggressive action on the side that's not being tested. All right, another couple of weeks go by. Russell hasn't really gone anywhere, 1425, so that's perfect. Now, the income potential's come down from 2,200 down to only 800 potential. So there's not much point holding this trade for another 3 weeks. Much better to look for better opportunities. Put spreads are tying up $19,000 in margin and only have $250 in premium left. You see that, the 110 less the 85. And the calls could come under real pressure if Russell rallies a further 1-2% from here. So again, bit of a judgment call. Profit target had been hit, but all our risk parameters were okay. But given that there wasn't much premium left in the trade, I felt it was prudent to close it out. So here we are here. Started, had a little bit of a pullback, but then rallied pretty strongly, adjusted. Again, if we had have left it, we would have been totally fine. But if it had have continued rallying, and again, that technical analysis, we're kind of breaking out above this high again. If we had have continued rallying, wouldn't have been hard to see the Russell jumping from 1430 to 1460 in a couple of days. And that's only 10 points below our short calls. Okay, Jason's asking, what's the typical profit target? So about $1,000 is sort of my initial profit target. And then if that level gets hit, but all my risk parameters are okay, the time to expiry is okay, I might hold on to it for a bit longer. But yeah, if I can make $1,000 on this sort of position size, you know, looking at our theoretical $100,000 account, $1,000 is 1%. If you can make 1% a month, that's pretty good. Okay, and you're only tying up, say, 18,000 of your 100,000, so you can have all that other capital working doing other things. All right, so another important concept that I want to spend a bit of time on, and again, make sure you pay attention here because this is important stuff. So Angel asked earlier about the May 22 drop. So we're going to look at another period when the market dropped, which was March 21st. So what's the worst thing that can happen with a Condor? Obviously, a big move in the underlying instrument is not what we want. This can be especially painful if it occurs early in the trade. Reason being, you're then fighting the trade for the rest of the time. If it happens later on in the trade, might not be as bad. You're probably sitting on some profits. Maybe you just give back a little bit of the profit. But if it happens on day one, and that's everyone's real fear, really, isn't it? When you put on a Condor and the next day the market tanks. Okay, it's very hard to fight your way back from that. So I'm going to look at 3 different Condors on the Russell that were entered on March 20th. Okay, the next day the Russell dropped 2.18%, and I think volatility shot up massively as well. Okay, so I'm going to give you guys a little test. We've got 3 positions. All started on the same day. We've got a monthly Condor with delta of -16. We've got a weekly Condor with delta of -12. And we've got a 90-day Condor with delta of -10. Which one do you think handled the drawdown the best? And which one do you think handled the drawdown the worst? Just type it into the question box there and let me know. Did the one with delta of -16 perform the best because it had the most negative delta? Yeah, good stuff. All right, see some familiar names in there. You guys already know this stuff. Yeah, exactly. So the 90-day Condor performed the best and the weekly Condor performed the worst. And you might be surprised at the extent. So let's take a look. The monthly Condor, down $550. The weekly Condor, down 2,150. This is why I don't trade weekly Condors. Exactly, wow. That's right. So you might be tempted with weekly Condors. You might do really well for a couple of weeks and you might make $500 a week. And then all of a sudden you get a big hit like this. Happens all the time. The 90-day Condor actually made a gain. Isn't that cool? That is why I prefer the longer term Condors. I'm going to try and find another image for you guys as well. This is sort of more advanced stuff. This is the one. Yeah. So the other thing, and we're going to talk about this in the volatility session, this is basically volatility. You can say this is option volatility. It's VIX futures, but option volatility on August 9th. which was the day before a big sell-off, and then August 10th, the black line. So we had a big sell-off on this day. Volatility shot up heaps. Short-term options, with say less than a week to go, you see the difference between the blue and the black line is massive. Sorry, let me just bring that over. Okay, so when there's a volatility spike, not all options get affected equally. A volatility spike massively affects short-term options. So the VIX, spot VIX went from 11 to about 15. Whereas if we go out 90 days, volatility didn't go up nearly as much, only went from 14 to 15. So that's part of the reason why those longer term condors don't get affected as much. We're going to talk about that in more detail in the volatility session. All right, so just keep that in mind. I know I harp on it a bit, but stay away from weekly condors. So here we'll see that same information graphically. Monthly condor down about 550. Weekly condor massively down, over 2 grand. Okay, I'm really under pressure. Not much you can do here. You're really almost taking a directional bet. Market goes up, you make good money. It goes down, you make bad, you lose a lot of money. It's not flat at all. Whereas the monthly condor barely affected it, or the 90-day condor, sorry, barely affected it. Still more or less in the middle of the graph. And hasn't even begun to hit that sort of down slope on the T+0 line. All right, so the other thing we were looking at was the drop on, when was it, May 22nd. So let's see if I can just load that into option view. So let's find the initial trade, April 19th, then we adjusted it, and that was our position. So let me just load this up. Bring this over onto my other screen. Okay, just give me a minute while I bring this up. Do it over here. So if we go back in time to April 25th, and I'll set up this position. All right, doesn't want to cooperate. What I might do that for the next session. I'll set that up so that we can see how this trade performed on that big day, 22nd of May. All right, guys, any questions? All right, question here is if your primary strategy is to sell premium, to what extent is the iron condor the only tool you need versus adding butterflies, etc.? Yeah, I mean, you can potentially just trade condors, but like I said, you don't want to allocate your whole account to condors. So you never want to be more than about 40% max in condors, and I'm usually at around 20%. So then from there you can add in other strategies like butterflies. What I do is I split my capital 50-50 between investing capital and trading capital. So with my investing capital, I'm buying dividend stocks, I'm doing covered calls, doing wheel trades, long-term investing strategies. Now the market tends to go up over time, so you want to have some money allocated on the long side. And then with the other 50%, I'm doing condors and butterflies and a few other different strategies, ratio spreads, things like that. So I've got a couple of spreadsheets that kind of help with sort of portfolio allocations among different strategies. If you're interested, just shoot me an email. I can share that with you. Do I trade different trades in different accounts? So an account for each type of trade? No. Do it all in the one. I guess it would be easier to track things that way. The one thing I wish Interactive Brokers did was allowed you to put like a code on a trade, so you could code it as an iron condor or a butterfly. But unfortunately, you can't really do that. You can do it within option view, which is good. So that's another good way to track your performance of a various strategy. You can also have lots of different accounts within option view. It means you've got to duplicate your trades. Every time you make a trade in Interactive Brokers, you've got to go and enter it in option view, which is a bit tedious, but that's a really good way to track it as well. What's the max number of adjustments you make before giving up? So yeah, really great question. So usually if I've adjusted a trade twice and then I'm still getting under pressure a third time, I start to say, right, the market's telling me something that I'm wrong here and it's time to give up. Yep. So probably no more than 2. All right, so someone asking about delta dollars. Understand how to compute it, but why is it important? So, all right, let me try and explain that. So, let's do this. Let's say your account size is 100,000. Okay. If your delta dollars is positive 20,000, okay. All right, so you've got exposure on the long side, and then let's say the market drops 1%. Okay, purely in terms of price, you're going to lose roughly delta dollars times the price move. You're going to lose roughly $200, which is very little in terms of your total account size. Okay. Now, I recommend a 1-to-1 ratio, so no more than 100,000 for your total account. If the market drops 1%, you lose 1,000, which is 1%. Now, if for some reason you let your delta dollars number get to 400,000 for whatever stupid reason, now all of a sudden, if the market drops 1%, you're losing $4,000 or 4%. So that's why I try to keep this number as low as possible. Does that make sense? So I have 2 rules. One is on my total account size, I have a 1-to-1 ratio, and then also on a particular position. So if I'm risking 20,000 on a Condor, I'll let this get to about 40,000. So I'm still, not losing too much of my account totally. Yeah, got it. Cool. Yeah, Think or Swim might allow you to add a code to your trade so you can track strategies. So yeah, Think or Swim probably a little bit better there. Do I trade condors on individual stocks? Not really. I will trade individual stocks, but I'll use other strategies usually. I just find, there's too much risk of a big move. You look at a stock like Tesla, Netflix, they can make 5-6% daily moves that can just kill your condor, whereas the indexes tend to not do that quite so often. Equifax dropped 30% recently. There's always a risk that there could be some sort of negative news item or a bad earnings report and the stock's down 10, 15%. It's a Condor killer. Will I upload the training sessions? Yep. So I'll send you guys the link if you don't have it. It's got all the information there. I have all the replays there in one spot. Okay, guys, any other questions, feedback? Yeah, exactly. It's the gaps that kill you when you're trading individual stocks because there's nothing you can do. Cheers, Tom. Yeah, any other feedback? Let me know. So next week we're going to look at some tips and tricks. Yeah, another good question. Do I consider closing one side of a trade? Yeah, definitely. So, if the market's moving up and my puts have got no value left, I'll sometimes just close them out rather than being aggressive and rolling them up. I might just close those put spreads and just manage the call spread from there. Yep, absolutely. All right, any more questions, guys? Happy to stick around. What trades complement Condors? So, yeah, you definitely don't want to have too many short vol trades on. So, um, I tend to add in, as I said, some long strangles if volatility is really low. Um, bearish butterflies can potentially be good as well. Um, if you've got a Condor that's got a bit of positive delta, you can add in a bearish butterfly that has negative delta, kind of offsets. Even just some directional vertical spreads. If you've got a Condor that's moving against you on one side, but maybe you don't really want to adjust it because your rules haven't been hit, you might add some vertical spreads in another underlying that help, bring your overall portfolio down to delta neutral. I'm not a big fan of calendar spreads, but calendar spreads are long vol, so that can help to offset the short vol a little bit. How many iron condors open at one time? So good question as well. There's two arguments. There's one is the sort of trade small, trade often mantra, whereas I tend to probably trade small, trade often. I'm kind of the opposite. I will trade a bit bigger and trade less frequently, and so I've got less positions to manage. So typically, I'm really these days just trading condors on the Russell. So I'll probably just have the one position, but I might say have two positions that straddle different expiries. So I might have an October Condor and a November Condor on currently. Yeah. But yeah, I'm not really trading condors on individual stocks. So in terms of total positions, I like to keep it under about 15. So I usually have a Russell Condor. I've got some covered call trades on, some other strategies and some ratio spreads. So generally, really just one, maybe two condors, and then a couple of other trades. And usually, yeah, just try to keep it below 10 to 15. Otherwise, I just find it just gets way too hard to manage everything. Cool. Oh yeah, and also in cash, yeah, definitely. So yeah, I tend to have a pretty large portion in cash as well, particularly at the moment. So just waiting for some opportunities, yeah. So I might have 40, 50% allocated just to cash. Longest drawdown, that's a good question. I guess, 2008 took a while to recover from for sure. Um, I don't have the stats for the last couple of years on that, but not more than a month or two, really. Yeah, yeah, a few weeks. I tend to not have too many big drawdowns because I tend to adjust pretty quickly. So I don't have those massive returns either. Just that sort of steady 10, 15% a year returns. Um, so again, we talked about Finance 101. If you're aiming for massive returns, you're going to have massive drawdowns. All right, guys, great questions. I hope you enjoyed that session. We'll be back next week. Any other questions or feedback in the meantime, just shoot me an email and happy to hear from you guys. So have a great weekend and I'll talk to you soon.